Drink your coffee, read your sports, listen to the Dream Report. Let pour it pour.
Welcome to the Dream Report, the week in appraising. It is Monday morning, July 6, 2026, and we are looking back at a June that quietly reshaped the math on both sides of the valuation equation.
Yeah, if you are sitting down at your desk this morning to finish up reports using cost or income models you built back in April or May, you are likely working with stale data. Both the cost approach and the income approach saw major underlying inputs move significantly last month, and we need to talk about what that means for the comps and the models we're putting in front of clients this week.
Let's start on the cost side, specifically with construction. Ken Simonson, the chief economist at the Associated General Contractors of America, released their June 2026 analysis, and the numbers are a wake-up call. According to the AGC report, inputs to new non-residential construction jumped 8.4% year over year in May 2026. To put that in perspective, that is the largest annual increase we have seen since the height of the pandemic supply chain issues.
That is a massive move, Marcus. But the really critical detail for appraisers is the disconnect between those inputs and what contractors are actually charging. The same AGC report shows that contractor bid prices only grew by 3.5% over that same 12-month period. When you see an 8.4% rise in what it costs to build something, but only a 3.5% rise in the final bid price, that is not a price signal. That is a clear compression signal. Contractors are absorbing that difference right now rather than passing it along to project owners, which means their margins are getting squeezed hard.
Exactly. And if you're running a cost approach valuation on relatively new iron or a facility using replacement cost new estimates built on pre-May inputs, your final numbers are going to be understated by a pretty wide margin. The diesel fuel index alone in that AGC report surged 105.9% year over year. That is a direct hit to mobilization and operating costs worth accounting for in any cost approach estimate tied to current market inputs. We cannot just rely on older index factors when the ground is moving this quickly under our feet.
It is also changing the behavior of the buyers, which feeds directly into the used market. On a recent episode of the Moving Iron podcast, the hosts were discussing how they have seen a surprising strengthening in used equipment values lately, even as new equipment sales have started to cool off. It matches up perfectly with what we're seeing in the broader dealer networks.
It does. If you look at the Fusible Equipment Dealer Insights survey from June, which polled about 400 dealers across the country, 50% of those dealers said they expect buyers to delay new purchases and hold on to their existing equipment longer. On top of that, 30% of those surveyed dealers cited cost hesitation as the single biggest barrier to making a deal right now. The structural takeaway for appraisers here is about the comp pool. When contractors choose to hold on to their iron longer because new replacement costs are too high, those machines are going to enter the resale market with more hours on the meter and at an older age than the historical norms we're used to seeing. The comp pool itself is aging, and that's a structural shift worth weighing when selecting and adjusting comparables.
That substitution effect is not just a theory. We're seeing it show up directly in the transaction registries. Fusible Equipment Data Analytics, or Fusible EDA, released their June 2026 data, and the divergence between new and used is striking. For example, new excavator sales fell 4.1% year over year in the June Fusible EDA report. At the exact same time, used excavator sales climbed by 5.3%. Because buyers are shifting to used, the average financed age for those used excavators has now climbed to 7.7 years.
That's a long hold time for a primary production machine, Dana. And it's happening in the compact market, too. Look at skid steers. New skid steer sales dropped 9.6% year over year in the June Fusible EDA report. Compact track loaders, or CTLs, are continuing to take over that market share. In fact, skid steers now account for just 14.5% of all compact loader financing. If you're still treating skid steers and CTLs as highly interchangeable without adjusting for that massive shift in market preference and financing volume, your reports are going to look out of touch.
And the ag sector is seeing its own version of this pricing firming. Kim Schmidt over at Farm Equipment Magazine reported that ag dealer pricing was up 1.5% year over year in June. That might sound modest, but it's an acceleration from the growth rate she reported the prior month. So even as commodity prices fluctuate, the actual asking price for agricultural iron at the dealer level is gaining upward momentum.
This new-to-used substitution is the common thread across all of these categories. When buyers get priced out of new iron or simply choose to preserve capital, they turn to the used market. That keeps the used supply relatively tight and firms up the residual values of those midlife and older machines. For us as appraisers, this is not just an interesting market trend to talk about over coffee, it directly alters the comp pool we're drawing from, the age distribution of our comparables, and the depreciation curves we can defensively apply in our reports. If you're applying standard linear depreciation models without looking at how the market is valuing these older, high-hour machines right now, your values are going to be off.
Now let's look at the income side of the equation because we had some significant movement there as well in June. According to the Federal Reserve Bank of St. Louis, or Fred, specifically the Fred series DCOICOITO, West Texas Intermediate crude oil fell by approximately 8% during the week of June 22nd through June 27th, 2026, dropping from around $77.50 per barrel at the start of the week to approximately $69 per barrel by Friday.
That broader June decline was primarily driven by two geopolitical events, the easing of certain Iran sanctions and the resumption of shipping traffic through the Strait of Hormuz. For fleet and transportation appraisers who are running income approach models, this is a critical detail. If you're calculating net operating income for a trucking fleet, a marine transport operation, or any over-the-road equipment where fuel is a major line item, an expense model built on $80+ oil is already out of date.
Right. The income approach is highly sensitive to operating expense assumptions. A roughly 8% drop in WTI during that week means fuel cost assumptions built before June 22nd are worth revisiting for any income approach engagement with an effective date after that. It's a brief factual shift, but if you do not adjust those expense assumptions, your projected net income is going to be artificially low, which means your capitalized value is going to be understated. Expense model freshness matters alongside comp freshness, especially when a single geopolitical event moves the primary cost input by 8% in 5 trading days.
It really highlights the core challenge of what we do. In the month of June 2026, we saw major movements on both sides. The cost approach side saw non-residential construction inputs jump 8.4%, while the income approach side saw WTI crude drop approximately 8%. If you're writing reports today and using index factors or expense assumptions from earlier this spring, you're working with stale data on both ends.
This is where professional diligence separates the average report from a truly credible one. Under USPOP Standards Rule 7-1-B, an appraiser must not commit a substantial error of omission or commission that significantly affects an appraisal. Furthermore, Standards Rule 7-4 requires appraisers to collect, verify, and analyze all information necessary for credible assignment results. That means resting on older index tables or static fuel cost assumptions without checking whether they still reflect current market conditions leaves the credibility of the value conclusion open to challenge. USPOP doesn't tell you exactly how many days can pass before your data is considered stale, but it does absolutely require that your final value conclusions be credible and supported by the market conditions existing as of the effective date.
That's the standard. The appraiser who takes the time to verify these shifts, check the indexes, and adjust their cost and income models before the client or a reviewer asks the question is the one who builds a bulletproof reputation. It's about doing the work up front so the report stands on its own.
Absolutely. Well, that wraps up our look at the week in appraising. We'll be back next Monday with more data and more analysis from the field. Have a productive week out there. Keep your meters accurate, and we'll talk to you next time.
See you next week.